Hello everyone, Bogdan is with you. Today I will tell you what inducement is and how it can be used. Inducement is a state of the market in which a predictable structure of future applications is formed. This is a preparatory phase necessary for subsequent movements to take place. The market is not able to make significant impulses in the absence of liquidity. Any direction of movement requires the opposite volume so that one side can act aggressively. The opposite side must be ready to provide liquidity. Inducement is a process during which the market systematically forms this readiness. From the point of view of the auction, inducement occurs when the market temporarily stops actively looking for a price. The price stops shifting, market aggression decreases. Limit applications have time to move and absorb pressure. The auction is in a state of relative balance. Technically, inducement appears as a calm and logical behavior of the price. The price maintains the same levels, makes repetitive steps, rolls, forms a visually understandable and stable structure. In this state, there is no clear initiative, there is no dominance of market holders, there is no acceleration. This is a phase of accumulation. It is in such stable conditions that most participants begin to systematically take positions. Participants enter not because of a sharp movement, but because of a repetitive confirmation of the same scenario, the same setup. The longer the market demonstrates stability, the higher the confidence. The higher the confidence, the more open positions. This leads to the formation of a positional skew. Most of the market begins to look in one direction and act according to one logic. This is followed by the predictable structure of stop losses. The key function of inducement is the accumulation of stop losses. When participants open positions according to the same logic, they almost always place the stops in the same places, beyond the obvious extremes, beyond the boundaries of the range, beyond the local minimums and maximums. These stops do not find obstacles, but they are known by the behavior of the participants. These are future market orders that appear when the price reaches a certain level. Inducement is not limited to stop losses. It also forms an open positional movement, open positions, which in the future may be forced to be closed on the market. This happens either when stop losses are triggered or when the structure is severely violated. When participants begin to close manually, in both cases, this leads to the appearance of aggressive orders. It is important to understand that inducement almost never looks like something suspicious or dangerous. On the contrary, it looks like a confirmation of the correctness of expectations. The cleaner the structure and the more logical the price behavior, the stronger the effect of inducement itself. That is why most participants fall into this trap voluntarily. From the point of view of the auction, inducement is a phase of accepting the current price. The market is temporarily in agreement with the current range, but this agreement does not mean the completion of the process. It means that the market is using this time to form conditions for future imbalance. When inducement is completed, when the movement itself ends, the market receives what it needs for the next phase. Predictable distribution of positions, stops in obvious places, concentrated liquidity. The readiness of one party to act aggressively in the event of the first violation of the structure. Inducement is removed when it purposefully enters the stop-loss zone or forces participants to close positions in the market. At this point, the conditional claims turn into real market orders, and the auction receives a stream of aggression, which previously existed only potentially. Removal of inducement does not necessarily have to look like a sharp impulse. Sometimes it can be a gradual movement, sometimes a series of movements. The criterion is not the speed, but the result of the appearance of aggressive orders and the destruction of the previously stable structure. After the removal of inducement, the market goes to the next phase if the aggression does not find enough resistance from the side of limited claims. The market goes into an impulse if the opposite party is ready to absorb the volume. The market goes into a phase of redistribution and balance. Inducement is directly related to a fair price. Most often, it is formed near the balance zone, where the market is really able to hold the price for a long time without shifting. This allows participants to feel stability and build up positions, and the market will accumulate liquidity without premature movement. Inducement is also directly related to imbalance. Without inducement, the impulse would not have taken place, or it would be short-term. Inducement creates fuel, and imbalance is the result of its use. It is important to clearly determine and separate inducement from manipulation. Inducement does not require centralized management of the market and does not imply deliberate deception. This is a natural result of the same behavior of participants under the same conditions. The market does not force, the market uses what has already been formed. Inducement does not determine the direction, it determines the presence of liquidity in the direction of which side of the auction will use this liquidity first and most effectively. Therefore, inducement is not a trading signal, it cannot be used as an entry point. Its purpose is exclusively preparatory. Inducement is not traded, but the market reaction after its removal. If this is not thoroughly discussed, participants begin to enter the market with an inducement. Perceiving stability as a confirmation, it is in this phase that the majority opens the way for the future movement. I hope you heard me well, friends. My statement about this incredible element of the MFST. Let's take a look at some more practical examples. With a classic movement, where the price is removed by inducement, we see a buy-in SMT reaction in this place. After this, the price goes down, renewing this minimum. Model itself is closed. Also, there is a removal here, and the price goes down further, renewing this minimum. It is important to understand that in all these cases, the minimum is confirmed after the removal of inducement, and the maximum is confirmed after the renewal of these minimums. Next, we see that inducement forms an internal movement, a secondary trend. As a rule, it is stronger than the main trend. The price removes inducement for a long-term movement and a renewed high. For us, this is a precursor to the fact that the price will turn up. Here we have resweep, absorption. And when retesting this zone, it would be ideal to buy these maximums. This is what it looks like on real graphics. Inducement is specifically directed from Katya to the correct correction. I shot a video about the correct correction. It is literally the past in this playlist of my novice base. Here inducement is removed, a buy happens. The price is within the framework of this buy. And after that, it turns around. Testing this zone. And here you can adjust the goal for the renewal of this minimum. Maximum simple but super effective logic, which will help you determine the structure and in general trade using the pipe strategy Nightstar as effectively as possible. Thank you all for watching. Like, subscribe to the channel, write comments. I will be very happy. Good luck to everyone and bye.